Hi, I'm Bob with Canary Mid-Century. We renovate and sell mid-century homes in Claremont, California. Let's take a look at the housing market for April 2023. Okay, let's take a look at the numbers in Claremont for March and see where we wound up. If you're familiar with our chart, the green is our original price, the blue is our sold price, and you can tell pretty aggressive as we came in with our original pricing up at about $1.1 million. Our actual sold median wound up around 916. So everybody got excited in February, a few more things coming on the market, and overpriced them a little bit. There could be some variation there because maybe we had one or two homes that were higher price, above well above $1 million. So not a problem there. What I want to look at on this chart is showing us, back in June of last year, we were right around $1 million for our median price. And we're just below that slightly. Again, 916,000 is our median. So we've dropped in our median price slightly, but this is a very small number of homes. We're only talking about 44 homes on the market and about 13 selling in March. So very small. So overall, we've kept pretty steady in our pricing. We bounced around a little bit last summer, but now we're in a position where we're starting to level off and maybe even see some increase. That's interesting. As we look at the historic count of homes that are available, we're starting to see a slight increase from February. February we had 41 homes, March I believe 44 homes. We don't look at April yet. Statistics aren't out, and it's only April 8th when we're talking right now. So it gives us an idea of what's happening here. We're seeing an increase in inventory and an increase in our pricing. So that's very good. Other locations like Rancho Cucamonga, they're showing a decrease in inventory and their prices are going up as we would expect. So not bad shape. I think I'll summarize this at the end here and see where we're headed. It's still a little unsure. There's a lot going on out there that hasn't been accounted for. So what does all this mean for Rancho Cucamonga and Claremont and Pasadena? Well, Pasadena being an affluent area with higher prices, their median reaching up into the 1.4 million. Tend to stay more steady. They have a higher inventory amount of in the 600s. They're selling about 50 some properties this past month, and so they're able to maintain a consistency. Now I would fear that the inventory would get older, but when you look back over the last 4 years, having 600 inventory and 52 selling every month is pretty standard for that location. In Claremont, a very small number of homes are selling, 8, 13 over the last couple of months, and we maintain a smaller amount of inventory, around 40, 50 homes or so. The interesting story is there in Rancho Cucamonga, where we see a decline in the number of homes that are available and an increase in pricing, which we would expect. As a matter of fact, their percentage rate, they have about 70 homes on the market, and they sold 50 last month. So we're seeing a huge percentage of homes being sold, and unfortunately, just not much inventory. So a large rush, if you will, towards those homes that are moderately priced compared to the more affluent areas of Claremont and Pasadena. So where are we headed for the summer? It appears that in Claremont and Pasadena, we're on the rise. Even Rancho Cucamonga, selling the homes that they are, the prices appear to be rising. What bothers me the most are the layoffs that we're hearing about at Walmart and Target and Disney. As we look at the numbers of folks in California, for instance, that can afford a home, it's around 17% affordability. So that's a concern. To me, I think that there is some more washing out that has to take place. I wouldn't get too confident about the summer. Maybe we hold steady in our pricing, but to see a lot of increase, I think that we're going to see fewer buyers show up to the market because of layoffs and the turmoil that we're having in the economy. So I'm not so sure that we're going to see a large increase in return to where we were in the high of last May. But for now, let's keep an eye on it, and I'll see you next time.